The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN, and as I promised you, we have a new president. I thought we would, and we certainly do. So we have 4 more years to decide whether we'll have another president the next time. Well, the main thing is we want to see what's happening to these markets, and we're having some really good reactions today. I'll start out with the E-mini S&P. What I've done is I posted into the Tiger TV the 60-minute chart of the E-mini S&P, because what happened last night is quite important, I think. We went up and we made a higher high than we did last Friday, and that was right up at the 61% retracement off the high we made, in the middle of October, and that sets up a big AB equals CD swing down to the 1368 level. We've already broken down below the low of the full moon on October the 29th, and we were expecting this thing to only last about 6 or 8 days, and it lasted 8 days, the rally, and stopping right at within just 2 points of the 618. We took out the high of last Friday in the S&P during election night by $50, 2 ticks. And I mean, believe me, folks, that is a really a bad sign as far as being bullish. And then it started to sell off, so it had a very negative tone to it. Right after it made that high, around 2 o'clock in the morning, New York time. 2 o'clock in the morning. It's 10 o'clock. 10 o'clock at night is when the high was made, I believe, and then it started to sell off, and that sets up our target, where the ABCD would come down around the 1368 level. It's a very clear ABCD. It's no different than the big ABCD that we had during the whole month of October, where we topped on the full moon on October the 4th with the 786, and then we, of course, went lower, and that's what we're looking at. And the important thing to look at that we're looking on the hourly basis, the fact that we're having a tremendous wide-ranging bars here on this hourly chart. In other words, the selling just keeps coming in and coming in and coming in, and that's not a very good sign if you're bullish. It's really difficult to try to catch a falling safe, and this is what you'd be trying to do. So I think that we'd be more inclined to think we're going to make that 1368, and we could make it very, very quickly. We're down over 300 points in the Dow, down moves that we've had in a long time. I'm showing the Dow only down 200 points, and the guy on Bloomberg said the Dow was down 300 points. So I'm going to assume that Bloomberg on Tom's system is correct. I don't do anything with the Dow. I basically do the S&P. So that's one of the things that we want to keep in mind that we're looking for at least 1368 on this next move. Now, we are at the 7th of November, and coming into on the 13th, about a week from today, we are going to be looking at our solar eclipse. We have 2 eclipses during November. We have the solar eclipse on the 13th, and then on the 28th, we have the lunar eclipse. And the 28th of November is going to be the big one, folks. It's after Thanksgiving, and that's going to be the really big date to watch, because that's a very key date because of what's happening with the planet Mercury. It's making some real serious astroharmonics at that time, so we want to watch that very, very closely. And this is one of the things that we want to follow. Now, we've been talking about this one particular stock that you folks might have heard of, and that is the stock of Apple Computer. And this is a textbook pattern recognition. If you go back and look at the ABCD pattern that we had in May, then you saw the big butterfly pattern that completed up in the 700 level, and we also had an island reversal, and we talked about these island reversals. This is where you have a cluster of days, and then all of a sudden the market gaps down below those clusters, leaving an island, and that basically means that there's been a change in the continuity of thought. In other words, everybody that's been thinking bullish, all of a sudden, there's some bearishness comes in, and that's what causes this. We had the same type of island reversal to the upside when we were in July. When we move in Apple, you'll notice that we had the same island reversal pattern where for 3 days the market was incredibly bearish. It was setting right near the 0.618, and then the next day it gapped up and continued to go higher from 560-something to the level of 700. Now, what's happening now is that today, we had a price objective that we've been waiting for a very long time of $566 a share. And what's happened with Apple is we gapped down below that price, or gapped down below, the area that we were looking at. And when you have that gap down, this is one of the, the two danger signals that you have in pattern recognition. The gaps you see very seldom. I mean, most gaps will be filled, but you do see gaps. That's a danger sign. And then also the very wide-ranging bars. In other words, a bar that is usually 3 times the normal bar. That usually tells you that there's more selling coming in. And so at this particular case, you have the 786 coming in at 566 on Apple computer, but unfortunately, we've broken below that. We're trading, below 563 right now. So it is, gone lower than what we had expected. And so if you, did some puts on this, and we have our friend in Singapore who trades Apple, Mr. William, and, he was really looking at the puts up around that 700 level. And I was chatting with him last night, and he was a happy camper. So, not all of them work this way, but this is a really a textbook of technical analysis. And when you stop and think that Apple is the biggest stock in the world, it's the highest capitalization of anything traded anywhere as far as stocks are concerned, and so it's very, very liquid, and it's very, has a lot of people trading it. And I think the main thing to point out here is when the top was made up there at that 700 level. If you remember, people were standing in line at the Apple stores paying people $100 so that they could get their i5 phones. And then on eBay, they were asking anywhere from 3 to 5 times face value for the i5s. Whether they got those prices or not, I'm not sure. But all it's doing is this chart is just telling you that this is pattern recognition. You don't have to follow the news if you don't want to, which I certainly don't. And that's basic of this. I mean, people ask me today, how is the election going to affect the markets? I don't know that, and nobody else does it either. Last night they were talking about how bullish it was going to be for gold, and gold made a high, then it backed off, $20-some. I mean, you don't know what these things are going to do, so all you can do is to try to simulate what you think these things are going to happen by looking at pattern recognition of what happens in the past, and then go for it. And that's really what you're looking for. So we have this big ABCD pattern completing in Apple, and this is being a place where if you're short, you certainly want to be covering your short position here. But the long position, if you wanted to take in Apple, you should wait a day or two because you've gone below that 786, and that's the very first danger sign that you want to look at. Remember, it's not the amount of money that you make on a trade, it's the amount of money that you have at risk on the trade, and that's what I think is the really important thing to look at. Now we've got one that really bears our attention, a great deal, and that is the Treasury bond market. We are really up in the moment of truth now in the Treasury bond market, folks. I posted into Tiger TV the daily chart going back over the last 6 months, and if you'll notice at this 150.11 area, the high today has been 150.12, I believe, and we have hit that level again. We've taken out the highs of September, we've taken out the highs of October, and we had this very, very wide-ranging bar. So if we close above 150.11 today, that's going to tell us that we're probably going to go higher. So at this particular point, the bonds are at a very, very critical level, and with the stocks, coming down, like they are, people are having their flight to quality of Treasury bonds, and this is what's going to be interesting, because if they break above this 150.15 level, that sets up a challenge to the 153 level, which would get into new high grounds, and then possibly a 1.27 expansion up into the 155 level, which would make this camper the happiest camper in the whole camping ground, because that would give us a chance for one more butterfly in the Treasury bonds up in this 155 level, because we missed the one at 154 by a little bit, and this next one, if we get it, could be, the last hurrah. I hope that it doesn't make 160, because if it does, I'll have to get that safety jacket, my life jacket, out of storage and take that boat ride with Mr. O'Brien. Will not happen. Okay, anyway, I mean, it may 160, but I'm not taking the boat ride, that's for sure. But we want to watch that, very, very closely in the Treasury bonds, because it's at the moment of truth, and there's no question that this is what we're looking at. Now, the question that I had that I wanted to mention to folks, and that is the price of gold, because we have, definitely had a pretty good move in gold over the overnight. And what I did was I just put up a small 5-minute chart, showing the move that we had in gold, because we got up to the 1734 level, and that was there are a couple little butterflies there on the smaller time frame. That was a larger retracement up there at that 1734, coming down from the 1794. And so as you walk through the night and listening to the reports of Obama winning, gold would rally, because that was supposed to be good for quantitative easing and commodities and everything like that. And yet, the market kept backing off, and gold went from 1734 down to that 1716 level, and then right after that it had a very strong rally up to the 786 level, and that made the spot that if you wanted to really get short gold, that was the best place to look at it. And then we hit that level, and then we broke down, and we took out the lows of election night on November 6th, and then we made a 50% retracement exactly of the low that we made on November the 5th. So over the last 2 days, all gold has done is it's made a low of the 1672 level, then we rallied up, $60 to 1734, and now we've come down to the 61%, the 50% retracement of that whole move. Now, the question that I get is that 1672 the actual low in gold? And I think it's too early to tell. I don't think you can do that on a 2-day time frame. All we did is we took out the previous day's lows and the previous day's highs. We took out that high above 1724 that we had last Friday, and we went up to the 1.27 of that at 1734. That was the high last night, and we haven't done anything. I mean, all it's doing is just bouncing around. So you can't make an assumption that that's it. Now, if that low on gold, well, we got to take a little break here. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
648, and we're discussing the gold market and the fact that the low we made today down around that 1700 level was a 50% retracement coming off the low that we made 2 days ago when we got down to 1672. Now, I posted into the Tiger TV the daily chart for gold, and if you get a chance to take a look at it, you'll see that the high that we made last night during the what they call it, the presidential election, we made a 50% retracement off the high from 1794, and the market didn't really go anywhere; it just backed off, a quick $30. And if it was really good, it would have exploded up and gone above, 1763. So all we're doing now is we're backing and filling, and I don't think there's anything to be excited about in gold. If we do take out, 1672, the low we made on Monday, then I believe that we have something that would be a little bit more sinister in the gold. But right now, it's just, just going up and down. That's really all it's doing. It still has a bullish bias, because, we've had higher bottoms since we started following this, way back in May. We had our second higher bottom, at the end of June. And then we had another one. The third one was in July. The fourth one was the end of July. The fifth one was in August. And we had 5 higher bottoms there in gold over a period of, 3 months. And, we were very bullish during that time. And we did get a huge move off of that. And now we're in the corrective phase of that. And I still believe that we're still in the corrective phase. We did go down, and we came down to about 50% of that whole move, and now we're just, I would think, backing and filling. Now, the people ask me all the time is, what is the the probability, that low of 1672 that we made on Monday, being the major low, and I don't think that can be answered yet. I think more information has to be given. The first sign that it would be big is the fact if we get above, the 1740 level. If we take out that 50% retracement from the 1797 high, then I would think that would be the first indication. But right now, I just think we wait, look at the smaller swings, and that would be the best way, to really follow this. In my opinion, I don't think there's any reason to be excited about either side of it right now. And it's just had a really nice move, and it's great to watch these swings because it really is a really something to to keep in mind while you're watching other things, that it makes it real interesting to trade too. Also, now I wanted to bring one other market up because it was very influential to what was happening to the markets last night, and it is without doubt the most actively traded thing in the world, and that is the euro. And the euro was making a perfect AB equals CD move, where it went a little over 150 pips to the upside, making a perfect ABCD on a 5-minute chart. Going back for the last 2 days, I posted that into Tiger TV so you could take a look at it, and you can see that we had an ABCD pattern up, and then we had our first Gartley pattern that came right before the Ohio contingent went to president, and that was a really nice Gartley there. And that Gartley failed immediately. You had a beautiful ABCD there coming down in that 128.15 level in the euro. It stayed there for about 5 minutes. It became a loss immediately, and that would have been a very quick 25-pip loss for about $300, because once it broke that, you'll see that the market just started to cascade down, with wide-ranging bars. And this is really important to look at this chart, folks, because these are all probabilities. We don't know which one of these things are going to work. No one else does either. That's the best part of what we're doing. Nobody else knows if these things are going to work either. So the only thing we can do is control our risk. And with this particular trade, once the Gartley failed at 128.15, you started to see the cascading or the wide bars forming. In other words, the bars became 2 and 3 times normal. Now, this is where people that don't use stops or don't use money management run into great problems, is because they don't realize that these are only probabilities, and some of these trades don't work. And this is a perfect example of a Gartley that failed. And then, of course, once it did, it just kept cascading down, and it finally stopped, down at the 1.27 level. And then ever since that time, over the last 4 hours, all it's done is just chop around and made a very small little rally, just a very small AB equals CD rally. So that's really all you're looking at here is, the probability of something working or something not working. It's the only thing you can do is control your risk. He who knows not what he risks it all. And you don't want to do that. That's, that's something that you just don't want to stand into. We've got to take a little break here. 877-927-6648, and we'll get to silver when we get back.
You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations, including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, folks, we're back, and we're going to talk about silver. We've had a pretty good correction since we made our highs in September, and also in early October around the full moon. And then we've come down to the 50% retracement level on Monday. That was at the 30-50 level. We've rallied about $1 an ounce in silver, which is not shabby by any stretch of the imagination. But what's important to look at on the silver chart, and remember, silver has about 1/5 of the volatility of gold. In other words, the number of players in there are about 1/5 as many as you have with the gold market, and so it's very, very relatively illiquid compared to the gold. And it's very hard to trade sometimes because the stops can be run if there's not any orders setting on the other side of it. But the important thing to look at on silver here is that we did not take out the highs of last night during the elections, whereas gold did. You remember gold went up to 1734, and silver should have gone above the 3280 level, and it never got any higher than 3220. And so it was lagging the market a little bit. So it's still in that basic downtrend, even though that it held, the 50% retracement of the low that we made, way back on the end of July. The end of June. So we made a 50% retracement of that whole up move, and so that has held relatively well. And so if you're bullish silver, you want to be looking to see if it'll back off to maybe a 61% retracement of this last 3-day move, and that would take us to about the 3100 level. But frankly, right now, I would not touch it. It's really still in a downtrend on a shorter-term basis, And these are the things that we're going to cover tomorrow, on the commodity hour. I want to cover these more in depth because they are, quite important. We also need to look at the copper market because we've had the same situation, occurring in copper that we've had with, with the stock market and with gold, because the copper market has been, far, weaker than the rest of the market, rest of the stock market, which historically that should not happen. And, I've been talking about this for such a long time, and that is the divergence that we're having in the Dow Jones Transportations and the Dow Jones Industrials. This is the worst divergence that we've ever had in the Dow Jones Industrials versus the Dow Jones Transportations in 130 years. So it's never been this bad. I've put this in my newsletter every week because I've been focusing on it. And, as I was watching the election results late last night, I was particularly interested in the senatorial race here in Arizona. And the main thing that I was seeing there is that, really this what they can do now is going to be very, very limited. And what the Dow Jones Transportation's weakness is telling me is that the products that these people are making are not being shipped in quantities like people are expecting. And that's a very bad sign. It's a bad sign for Christmas sales, and it's a bad sign, for the overall economy. And, if you want to see how good Christmas sales are going to be, you want to watch the stocks of UPS and FedEx. Those are the ones that are shipping the goods, and that'll be a big indication of what kind of a Christmas holiday we're going to have. So just remember that. Now I'm going to put the chart of the copper into the Tiger TV. You can see that it's been incredibly weak compared to the rest of the market. And now, for the first time in a long time, is we're breaking below, the 61% retracement. I talked about this on Monday, that, copper should hold, $3.46 a pound, and, we're trading below that now. We're at $3.45 a pound. And that sets up, the possibility the 618 is not holding, and so you'd be looking at the 786 at $3.36 a pound. So again, it is also telling us that the stock market is very, very weak. I mean, I don't do anything with fundamentals. I'm just telling you where the buyers and sellers are, folks. And the news should have been a lot better for some of these things than one would think. And I'm just saying that, if the markets don't react the way you think they're going to react, they're going to react the other way. There doesn't change, there don't have to be rocket science to figure that out. If prices don't go up, they're probably going to go down. So that's what you want to keep in mind as far as, why to look at these things the way we do. So keep an eye on the copper. We'll be covering that more on the commodity hour. When we do that tomorrow, because I think it's relatively important to keep a clear head when you're watching that one, because all these things are really, really exciting to watch, but you have to be able to be sure that you're able to understand which ones are the best to really look at. Now the next one I want to take a look at is the NASDAQ. This was the chart that I put in the newsletter last week. And to show you the ABCD pattern coming in at the 61% retracement that it formed there. And, of course, we watch these levels because they are, so very important when we're trading, because they act as, major support. This is one of the things that Basil does such a great job on, and that's, why we're, really interested in watching these things, is because the numbers that he comes up with his wave analysis are very similar to, what we're looking at. And we have really shattered the lows of last week, by quite a bit in the NASDAQ. We have taken out those lows, much like we have in the S&P, and that was below 2,600 in the NASDAQ. So there again, we're setting up a potential for a considerably lower market in the NASDAQ, and I will try to bring this up so I can show it to you in a little easier format here so that we can see it quickly. And I'll do that in just a second. I can't do two things at once because it becomes a little too difficult for me. Okay, there we go. We're ready now. From the high we made, last October, in the middle of October, that sets up a price of around the 2520 level. And I believe that would be another some points down in the Dow, from where we are right now. So this is what we're looking at. Is we've been in a downtrend since the middle of September. If you remember, the NASDAQ topped first in the middle of September. Then on October 4th, we topped on the Dow, and then we also topped on the S&P. And now we've been, heading down, for quite a while. And it looks like we're getting ready to go lower. We broke that low of the full moon on the 29th of October, and that tells us that cycle that was there usually lasts from 3 to 8 days, and we did go out into the 8th day, and so that makes it, very, what I think formidable as far as giving indications, to the downside. That's the way I'm looking at that right now. Now, I need to go back because I happen to be watching a trade because we happen to be in this, and it was working most of the day, and now it's starting to, give us an indication that it's failing, and that is the Treasury bond market. We were looking at this at 150.80, and it did everything that we could possibly ask for as far as how it was acting. In other words, we wanted to see it take out those highs from last September and October in that 150.11 area, and we did that. And then after the market didn't run up, we assumed that the selling was over, and we went in at that 150.80 level. Now, when we put on a trade like this, we're only going to risk 10 ticks, which is 320. I think it's 320. Let me see, 31.25. It'd be $312 per contract that we do, and so it's 31.25 per tick. So we're going to risk 10 ticks on this. So selling it at 08, our stop would be at 18, and right now, we're not too far away. It's at 150.15. We did get one down to 149.30 earlier, which would have been just shy of the first profit objective, but we didn't reach that. So the possibility of this trade not working is getting rather high. And so our assumption is that we're probably going to lose, but that's still not in the cards as yet. But we will, re-enter again when we get another, trading opportunity. Now, someone asked the question is, how did I come up with that, the new high coming in at the on the Treasury bonds? And what I'll do is I will draw the larger picture in here so you can see the where the price objective would go if we start to move higher. And this would be the one that I would really, I would really absolutely love this one if we get there, and that will be up in the there. You'll be able to see it very clearly. It'll be up into the 155 area, and that's the one that would really be the one that makes it what I think would be a mouth-watering trade. But I thought the one at 150.08 was mouth-watering, and, I have a dry mouth on that right now, but that's the way it goes. But if we do get higher there, that would really be a beautiful trade to look at in the bonds at that 155. The problem at the 155 level is you're only 5 points away from Tom O'Brien's magic 160 level. And our little bet that we have with Tom is that if the bonds hit 160, I have to take a ride on one of his yachts. And I told him I would, but I didn't tell him it had to be in the water. I'm going to wait till it's in dry dock, take a trip down to Clearwater, and then ride in the boat as it's being worked on in dry dock. That way I will not violate the principles of betting and still pay the bet off and still be in the boat, and everybody's happy. But I ain't going in the water. Will not happen. So this is what we're looking at in bonds, and we want to take a look at the notes, too, because the notes, being a shorter term, notes are from 1 to 5 year. Bills are from, 30 days to 1 year, and then notes are from 1 year to 5 years, and the bonds are, 10 years and longer. So notes are 5 to 10 years, and then the after 10 years, you're looking at the bonds. And so we want to take a look at the notes because it has the same type of pattern. But the difference here is that the notes, they are actually a little bit weaker. And you'll see this weakness because you'll see the beautiful pattern here in the long-term basis. But you'll see that the notes have not taken out the August and September highs. The bonds have taken out August and September highs. This is another divergence, folks. This be the possibility that, maybe this cycle that we're having in the interest rates is getting ready to, possibly, move rates higher, which history says that's what it has to be. I know everybody's searching for yield, but history says that's the wrong thing to look at. We've been in a bull market in interest rates for 31 years, and, this is not going to stay this long, much longer. So we have not taken out the highs on the notes for either August and September, but we have in the bonds. So there's a divergence starting there. You want to keep an eye on that divergence because it's a very large market. These are huge markets, folks. These are many, many times larger than the gold and the soybeans and things like that. This is these notes and bonds. This is big money moving this. This is why the euro moves as much as it does, is because of the bond, the bonds and notes, people moving stuff into those things as far as a flight to quality. So those are the things that we want to be watching. And someone asked a question about one of our old favorites, and that's TLT. And I actually don't like the ETFs because, I frankly don't like the way that they treat these things. In fact, they did a reverse split on these, just recently. So it's really the pattern that you're looking at is, not anywhere near what we're looking at with the bonds and stuff. And so I don't even want to go there because it just is not a very good vehicle for trading as far as what I can see. And I'd rather you look at, if you're going to do the bonds or the notes, look at a put, and go out, one strike price. If we get to that 155 level, we'll take a look at these puts. The last time they were at 154, the put premiums were so high that it was ridiculous because someone was assuming ahead of time that these things were going to move down, and they were willing to pay up for the puts, and that's why they weren't cheap. And that's very unusual because when markets go up, puts should go down, and the bond puts were not going down when the bonds were going down. And so that's an anomaly that you got to pay, what I think relatively, good attention to. So those are the things that we're looking at in the bonds and the notes right now. The fact that we did take out the highs of last August and September in the bonds, but we have not done it in the notes, I think is significant. I'm basically short the notes, the bonds from 150.08 with a stop at 150.18, and if I get stopped out there, we'll look to re-enter later after we get a better pattern. But it did exactly what we wanted today. It held above the 150.10. No big sell, no big buying or anything, and then it gave a good chance to sell it. Backed off, 10, 12 ticks, but it didn't work, and so you just have to, pay the pauper if you lose on this one, and then we will, look at it again, and that's how you handle it. That's basically, all you can really do, when you're doing any of these trades. That's the real beauty of pattern recognition is that you're able to come in and do this. Now, I wanted to mention I like to listen to Basil because the stuff that he does is really superior with the way he looks at support and resistance, folks. And this is something that we've been doing in the VIX index. We've been watching it for quite some time. And in the really long-term cycle, that cycle is held, relatively well. And, we had a 2-year cycle low in the VIX index, way back in April. We've never really broken that. And now we're in the situation now where we've had higher bottoms through here. Basil was, talking about that on his show. And, we need the VIX to get above the 120 level, and that would tell us that we would have, something even.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, good afternoon, folks. We're going to finish up the show. I'm going to do something I don't do too often, is I'm going to review what I did at the beginning of the show, because this stuff I think is that important. The main thing that we talked about earlier in the show was the fact that the E-mini had broken below, E-mini S&P, and also the S&P had broken below the full moon date of October 29th. We rallied up and made the 61% retracement last night after the election, and that tells us that we're setting up a potential target down at the 1368 minimum. And the fact that we come down so hard in just in a matter of a few hours, that tells us that we're most probably going to exceed that, on the downside. So that's one of the things that we wanted to look at. Now, the next thing that I wanted to bring up, and I've had several people ask me the question about it, and that is the Treasury bonds. I went into the Treasury bonds today at the 150.08 level with our stop up above the 150.18, and it started to work, and it worked relatively well for a while, and in the last hour or so, it started to fail. And the question someone had said, we've got this very, very wide-ranging bar on the daily charts. Why did I fade or go against the wide-ranging bar? Well, what I did was I was watching the intraday action on the hourly charts, and when we took out the 150.09 level, the market really didn't do much. In fact, it went down about 13 ticks. And but the problem is that even after that, it started to rally, and that tells me that I'm wrong. And so the question is asked, why are you risking 10 ticks and maybe, risk a full point? Well, I believe in these numbers so much that I have to respect, this wide-ranging bar. So this is one of the situations where we've taken out these highs of, September and October, and, this is what we're looking at. So I want to be, just be careful here and just not risk more than $312 per contract. Because if it's right, it's going to make more than that. That's the bottom line of, what we're looking for. Now, the next one that we're looking at and that we follow all the time, of course, is the price of Apple. And, we posted that into the room, and we had this gap down. Apple has, it's been trading under, 660, quite a bit of the day. And we were looking at it to go to, 560, and we were looking at it to go to the, 566 level. And so the only way you can buy Apple is let it to hold this level for a day or two, and then, see if you want to do it. Because we have the ABCD present, but we have a very strong move down in the CD leg. And so with the gap that we had today, gapping down, that's another, very, very strong danger sign. So you don't need to be a rapid buyer here of Apple. But if you're short the stock, this would be a time where you certainly want to be, lowering your stops down, quite a bit. If I were in short the stock itself, which I am not, I would put my stop in at the high of the day today, whatever that high. I believe it's around, the 575 level. And when you're trading a stock that's trading like this, you have to risk 3%. So you're looking at around $15 as a